Welcome to Principles and Practice of Insurance. So, today we do the introductory session about understanding the basic concepts of insurance. So, when you say insurance, I'm sure you have heard this, and there are insurance in terms of health, in terms of motor, in terms of cargo, in terms of general housing, like that there are so many different types of insurances. So today we are going to understand what do you really mean by insurance, and also and what is this insurance concept is all about. And we are going to learn a little bit of technical words under insurance and understanding an overview of what is uh, the concept of insurance. So, to begin with, let's try to understand what do you really mean by insurance. Now, a lot of people see insurance as a luxury product. In some part of the world, insurance is compulsory and it is there in every level of the society. Now, in Sri Lanka, insurance is something, as I told you, kind of a luxury product, and we see uh, the general under general insurance, the motor insurance as something compulsory because every vehicle which drives on the road must take a minimum third party insurance cover. So we will go back to these details later. So there it gives you a compulsory requirement that you need to have an insurance policy. So therefore people tend to take an insurance there, and this is something you have heard of some time ago, and you see a lot of advertisements, and it's something that people know. But when you look at the concept of insurance, it's very interesting to understand how this uh, how this concept has derived. Now, when you go back to the history of insurance, it is very far away. Some says it is time even at the Greek and Rome civilizations and the time of ancient kingdoms, and there are a lot of examples and evidences to prove that insurance have been there throughout the uh, different or many civilizations. Not as the word of insurance, but basically sharing the risk or reducing the risk. Now, I would like to take you through this concept by this word called sharing the risk, because I believe insurance is all about sharing the risk. Now, if you take an example of an insurance policy, let's say you take a motor insurance policy, you are going to insure your vehicle. So, there are so many people who has a common interest that they need to insure their vehicle, and then they get together and agree to certain conditions and terms, and they take an insurance policy for a one financial year. So if you met with an accident, if you have a serious injury, or if there is a death related to the insurance, there will be compensation. So you can see there are a couple of sections for this. There's an insurance company who is going to insure you. There is a innocent party who has been injured and suffering, and there is a owner of policy. So you see, there is a uh, there are so many stakeholders in an insurance policy. So let me take you through the next slide. What do you really mean by insurance? The word insurance. Technically, there are given some different definitions. So I'll quickly take you through some of these terminologies. The basic philosophy of insurance is a cooperative device by which the loss likely to be caused by an uncertain event Now, cooperative device is something I'm sure you have heard of. Cooperative device is more of a now in Sri Lanka we have cooperative societies. So again, it's a collective arrangement. It's a collective arrangement, cooperative device by which a loss likely to be caused by an uncertain event. So we are talking a lot about uncertainty, uncertain events, right? Because if things is certain, then there is no need of a policy. Because it's uncertain only, we have uh, this risk coming in. So these uncertain events is spread over a number of persons who has exposed to it and who propose to insure themselves against such an event. So so as you can see the wordings, there are so much of people who believe that they will be exposed to this an uncertain event, and that's a collection of people who have a similar interest. So thus insurance is an instrument to cover the risk perception by group efforts. Now you can see it's not just um, a set of uncertain events, but there's a group of people who was exposed to these uncertain events and who has the intention to secure themselves. And continuing, financial sense insurance is a social device providing financial compensation for the consequences of adversity, the payment being made from the accumulated contributions of all parties participating in the arrangement. So what do you mean by that? So in the top part we discuss that there is an uncertain event and set of people who are exposed to have gathered themselves to go against such uncertain event as a risk strategy. And also it's also said it's a social device providing financial compensation. So in an insurance cover, you will get a financial compensation, right? The consequences of that, the difficult things that you go through, the problems that you enter, uh, and those problems will be compensated from a, that's another important thing, from an accumulated contributions of all the parties participating in an arrangement. So the payment is coming from accumulated contributions. So what do you mean by accumulated contributions? That means that, as we discussed the top part, when people get together, they collectively build an accumulated contribution. We call accumulated fund also. And then through that fund, when actually somebody going through adversity or a problem or difficult time, it will be compensated. Right. Now, this is a very interesting thing. Right. So let's try to understand what really mean by uh, this definition. Right. Now let's try to understand how this concept works with a simple example. Normally, this insurance concept initiated with trading, with traders, especially cargo and shippers related businesses, and also for farmers. So this is why it was going for very far era how this actually came up. So let's try to understand in a simple context how this concept arise. I'll give a simple example for that. Suppose there was a farm, and the farmer, there are farmers, and they are mainly cultivating, and there are cows for each farmer has cows. So let's take a simple example. There were 220 cows for each farmer, and then there were around 400 farmers in this village. So, so each farmer has 20 cows and there are 400 farmers. That means we are talking about 8,000 cows. And then um, let's try to understand this concept with a simple example. Imagine a village of farmers. Each farmer, let's assume there are 20 cows. So you have 20 cows and there are 400 farmers in this village, which means we are talking about 8,000 cows. As you know, for a farmer, each cow is very important, and that is their mainly livelihood. Now imagine we are talking about 800 cows. Let's try to understand the value of those cows. We'll take a simple example. Okay, each cow worth 50,000 LKR, 50,000 K. So 50,000 into 8,000, what would be the value? We are talking about 400 million rupees of value. So this is the total value of those cows. We are talking about 8,000 cows. Now let's try to understand how this insurance come into the picture. Now the main concept, as I told you, in insurance, we are trying to share the risk. Suppose we have 20 cows. If something goes wrong and all these 20 cows or 10 or 15 cows died, for a farmer it's going to be a financial shock because majority of their assets are destroyed, and that will badly impact their livelihood development. So let's say now you have 400 farmers, they get together and each person is willing to contribute, let's say 40K per year, because now they have 20 cows, and 20 cows into 50 is basically each farmer having 1 million worth of assets. For that 1 million they are trying to, let's say, release 40,000 K per annum. So imagine each person is going to contribute 40K and we are talking about 400 farmers. So we are going to have rupees, how much? 16 million worth of a fund. We call this accumulated fund. How does accumulated fund arise? We have 40,000 per person, that is premium, into similar interest of 400 farmers, and when they contribute we got a 16 million contributory fund. Suppose every year we know things are happening, natural disasters, sudden problems. Imagine during this year 200 cows died. 200 cows died. That will be actually calculated in a probability tables, but here what I ran, we can calculate through now let's assume we got 200 cows died in a particular year, and if these 200 cows died, right, and we know each cow is worth 50,000 K, and what is the value of that? 50,000 K into 200 cows, it's gonna be worth 10 million. Now those who actually affected by this 200 farmers actually going through a lot in their life because they are making a huge financial loss. Suppose now the insurance, the contributory fund, is going to give that per cow of 50,000 and they are going to release 10 million, and still they got a profit of 6 million, which is going to be retained. Now let's imagine the same concept is what we call insurance. We have 8,000 cows. Actually, from that 200 cows died. So all these farmers went through a financial shock, which is being compensated by the value for them, and they are going to be received 10 million. And still the fund will be remaining same, and it's continuing every year. This is the simple concept of insurance. Just imagine if you are one of these farmers who lost 20 cows. Now you are not going to lose your life because of this, lose your livelihood because of this, lose your business because of this. You are going to be compensated. Of course, somebody may think, okay, I paid 40,000, but none of my cows died. So all that money is going to be wasted. So some fund can think about it. But just imagine, he or she completely transfer his or her risk by contributing to this fund. And if actually uh, a disaster or a natural or some kind of a issue happen, and if you lost your cows, you're going to be compensated, and then you can continue your livelihood development, you can continue your business without a financial shock. So yes, this 40,000 will be compensated from that. Right. So this is how I can explain the concept of insurance. In the real world, this is how this insurance coming in. Of course, it's just more technicality. It will have more new items coming in, more concepts, but at a nutshell, we can understand insurance, how it's arrives. But so you can see this risk is here only 200 cows. Suppose this risk went up, which is like very high. There may be years we may at a loss. And if it is a huge disaster comes, we will be having a crisis. So to avoid that situation, insurance companies reinsure themselves. So they reinsure to another reinsurer and to another reinsurer, and then they will share this risk of a major catastrophe across many insurance companies and further reduce this risk. So therefore, this is very important to understand the concept of insurance and how it works. Right, okay. Now you have an idea about this simple concept of insurance. Now let's try to move on to the history of insurance. I'm not going to go into detail about this, but I think it's good to have some idea about that. I have already shared a paper about the history of insurance, so for you to get a better idea with the main details of it. So while reading it, you have a better idea about the history. But just to highlight the key points in the history of insurance, we can't forget Benjamin Franklin founded America's oldest continuously active insurance company in 1752. So uh, so those days, as I explained, it's mainly insurance was mainly driven by business associates, and they were mainly concerned about their merchandising, and then being the shippers, what they can minimize the risk through insurance. So the first concepts are coming from they say 1688, where the Lloyds of London are trying to discuss about the concepts or the key points of the insurance today. in a coffee shop. So therefore keep that in mind, that it's coming from, mainly these concepts are coming from 1688. Right, so this is just a picture that you can see about how people were discussing at the Lord's coffee shop. So so here it will give you more details, initially how they come up with this underwriting society, and then how these ships, merchandisers and shippers on their cargoes try to look for financial protection to mitigate their losses, and the concept of mortality tables coming in 1693. Now that's pretty old timing. So um, so Sir Edmund Halley is talking about mortality tables. Now, those who are not clear about what is mortality tables, it's like a, life expectancies table. For example, based on this table, you can understand the possibility or the probability of your death uh, from your current age to your next financial year. For example, if you are 30 years, okay, what is, they will calculate what is the probability for you to die before 31 years. So it's pretty interesting table. So it gives you the ability for you to basically die. It's a probability calculation. And when you, especially the life insurances, when they are going to develop these life insurance policies, and where your death as the main uh, compensation point, they will definitely calculate these mortality tables in order to calculate the expected insurance premium. So for example, if you are into 50s or 60s, there will be a high probability that you might die in the following year. But if you are in 20s and 30s, there will be a very less probability of dying in following year. So what they say is, before your next birthday, what is the chance that you are dying? So that measured through these mortality tables. So we'll discuss and calculate some of these things in the future, but just to give you an idea. Right. Now it comes to another very interesting point, that is, they say not all the risks are insurable. Now, if I ask you, what are the risks available for us? You might be able to think and to take five, I would say take 3-4 minutes and think about or list down what are the risks that you are facing, what are the risks around you. Let's say now you're at your um, house, and let's say you want to uh, go from your house to let's say University of California, or for another particular place. So you can list down the risk that you will be facing throughout this process from your house to your destination. You can list out the risk that you can face. So there you will try to, you are trying to understand the possible risk. So I want you to take 1 or 2 minutes, quickly list down the risk which you might face. Okay, so let's say the clock start now. Take, quickly list down at least 5 risks that you think that you will be exposed. Now when you say risk is, now you know what are the problems that you may face, right? Okay, so let's try. Okay, I'm sure now you have a set of risks. So let's try to see what are the risks out of this can be insured, what are the risks that you cannot be insured. So I presume some of your answers would be okay. I'm supposed to go for a particular time. I might be getting late. So there's a risk of getting late. And I'm actually going, let's say, I have to walk from my home to, let's say, I'm planning to go from the either from a public transport, or I'm going through a triso. So to the place that I want to go, to the bus stop or to the three-wheel park, I may have to walk. So while I'm walking, I might fell down, right? And then I might hit for a vehicle. I might, met with an accident. And personally, I might get, let's say, a heart attack. I might, going through, let's say, uh, so I get into the vehicle, and while I'm getting the vehicle, I might, fall down. Or there in between, there may be a person who is coming and, trying to take my wallet away and, threatening me and going away. Maybe a situation, maybe somebody, for a girl, is wearing a chain, some there will be a thief who will try to take the chain and run away, and maybe a bracelet of a guy. So you can see there are possible risks that you might be going through. And then so you go to the place, and these are possible risks. I'm just listing couple of risks that you might face, right? So now, um, out of these risks, think about what are the risks that you can insure, what are the risks you cannot insure. There may be some risks where you think that you can insure, and go to an insurance company and open an insurance policy, and if some after that event where you can claim it and get a compensation. So that's a one possible um, thing that you think that you can be insured. But there are things that you feel that you can't insure. Now out of this, I just list couple of items. Take the first item that I just told you, the item that I am getting late. Now, do you think that we can insure that because you could not go on time, there was a loss, as that loss can, so that I can, I need to recover that loss and make an insurance policy for that? What do you think? Looks like it's difficult and it's not possible. But let's say you met with an accident, and then you went through a personal injury, and when you, let's say broken your leg because of that. Maybe if you would have put a life insurance policy, and then, and if you covered personal injuries and going through this kind of a situation, you might be able to recover. If you're going in your own vehicle or a bike, if you met with an accident, if your bike is fully insured, you should be able to claim for your injuries, right? So there are things that you can insure, there are things you can't insure. So this is what we are trying to understand, the pure risk and speculative risk. They say the pure risk can be always insured, but speculative risk cannot be insured. For example, we go into detail, but I'm just trying to give you a simple example. Now, out of this list, most of you have been highlighted the pure risk. Now, the main advantage or the key feature of these pure risk is, anyway, if something, anyway, because of this event, you are going to make a loss, and it's always a loss. It's not going to be a gain. It's not going to be a gain. It's going to be a loss. So it's definitely this event go for a loss. You met with an accident, somebody is going, a thief is going to take your wallet, and you fell down from the bus. All these are will lead for a definite loss. But getting late is something that you can turn around. Getting late, sometimes it can be profitable also. Sometimes uh, there is always a two type of outcomes. There's a chance of a possible gain also. Now, for example, let's say if someone want to insure that for a trade risk, okay, when I'm running my shop, I might get into a loss. I want to insure that loss. So that is a situation where we can't insure. Why? Because it is not a definite loss. It can be a gain, it can be a loss. It's a dependable outcome, unlike the first one. So therefore they say speculative risk cannot be insured because there is always two options. There is a possibility of a gain as well and there is a loss as well. So to understand more about this, let's go to the key features of the insurable risk. Now, do you know that there are very interesting cases on insurance? Now, for example, there was a time, now if you take some of these sportsmen, some sportsmen, they insure their leg for millions and billions, right? Some people, they insure their throat, not the leg. What do you think? Why they are insuring the throat? Because if they believe that is the most important part of their body, and if something goes wrong to that body part, it will have a huge impact for their profile or their life or their main source of income, that is something you can insurable. So therefore they will insure their throat. Mainly that's going to be a singer then. So for a singer, your throat is very important because the voices come from there, and if something goes wrong to your throat, that's it. And for a football player, your leg is the most important body part, and if something goes wrong with your leg, you will not be able to play for the future. Like that, there's a requirement that we call this insurance subject matter. There should be a insurable risk. So if I just highlight couple of things which we call the insurable risk, then you will have a better idea out of this list that you have highlighted, what are can be insured, what cannot be insured. So the first point, it should be measurable in financial terms. It should be measurable in financial terms. There should be an insurable interest. There should be an insurable interest. There should be a relationship towards the subject matter. What do you mean by that? Like I said, the leg for the sportsman, the throat for the singer. There should be an insurable interest. And it should be measured in financial terms. If something went wrong to my leg, I'm going to lose this much of money. If I'm going to lose my throat, I'm going to lose this much of income that I'm monthly getting. So it should be measurable. And the third point, it should be exist in sufficiently large homogeneous groups. And this is a bit special because now they give the example for motor insurance. Now in such situations, your vehicle, there are a lot of vehicle owners, and every vehicle owner face the same risk of a accident while they are driving. Whether they are driving perfectly, there somebody come and can knock your vehicle. So therefore, if you have a large homogeneous group or group of people who have the same similar interest, that's also very helpful to insure your subject matter. And then another point, there should be a possible probability to loss calculation. Now you have to there's always there's tables where we calculate the possibility or the probability of the loss calculation. So if something goes this there's a loss of this is the probability of losing that amount. So there's a calculation for that, which the insurance agents are utilizing, especially the underwriters. It should be a pure risk. We just highlight that it has to be a pure risk. There's only one outcome, it's going to be a loss. It is of an entirely unforeseen nature. So this is something you can't predict. You don't know what's going to happen. It's very unforeseen nature. If it is certain, then there's nothing for you to worry as a risk. This is uncertain. That's why. The cost benefit should be reasonable in manner. So this cost and benefit should be reasonable in manner means whatever the amount that you are going to calculate, that as income has to be reasonable. And for example, let's say let's say you are looking for a life insurance policy, and you are asking the life insurance policy, okay, uh, a guy who is earning 100,000 a month is asking for a 250 million life insurance policy. So we have a question: is it on a reasonable manner? And the next point also connect, it cannot be widespread as beyond the financial capability. What do you mean by that? Now your this loss, when it comes to um, when you are trying to insure, it has to be within your financial capacity. It cannot go beyond the financial capacity. What do you mean by that? You have to um, there should be a possibility that you can pay the insurance policy on a regular basis, and you need to ensure that if something goes wrong, that somebody will be able to compensate. For example, let's say you are 35 years old and you have, let's say, two dependents. You have two kids, you are married and you have two kids, and currently you are earning 100,000 a month. So the main important thing that you need to understand is, by looking for a life insurance, if something happened to you, your spouse and your dependents are going to have a financial issue. So that means if something, let's say you met with an accident or you suddenly died, they are going to lose 100,000 a month. So they need to, in order to compensate this 100,000, the insurance policy will calculate, okay, in order to get you 100,000, how much of what kind of a insurance policy that you should go for. For example, for you to get 100,000, I'm just doing a simple math. For you to get 100,000 a month, let's say, as interest, how much you need to deposit in a bank for you to get 100,000 like per month. Let's say for a simplicity, 12% per annum is your fixed deposit rate. That means you need to invest 10 million in the bank for you to get 12 lakhs per year, so that you will get 1 lakh per month. So in other words, you need to have 10 million in your bank for you to get 100,000 monthly salary. So the insurance company will say, look here, you can go for then 10 million insurance policy, because that is your financial capacity. So you can't go beyond your financial capacity. So a guy who is getting 100,000, you can't think, okay, I want a 2 billion insurance policy. Right? It's going beyond your financial capacity, and it should be, your cost benefits has to be at a reasonable manner. Okay, so these are the list of items that I want to highlight. The features of insurance or insurable risk. Right, okay, so another key terms that I wanted to highlight, we call the physical hazards and moral hazards. Now, physical hazards are mainly the problems or influence issues or damages that you face physically or tangibly while you are uh, do things on a day-to-day basis, right? All the So if you are in a construction company or in a construction site, there will be so much of different type of problems that you will face. There may be different type of injuries because of using machinery. The bricks can fall into your head,
all different type of injuries you may have face, which we call the physical hazards, right? But moral hazards are a bit different. They are difficult to calculate. They are very subjective. They are mainly go. They call this. They are not physical. They are intangible because it's affect with your honesty, carefulness, and business aptitude. Now, for example, I'll give you a simple example for you to understand. Let's say some people, when you insure your vehicle, when you insure your vehicle, you have a different attitude. That is, okay, I can drive the way I want. If something goes wrong, if I met with an accident, somebody is going to cover that insurance policy for me. Why? Because I have insured, I have paid the full amount. Now I can drive the way I want. So you recklessly drive. You're not honest. You're dishonest because your behavior is such. Okay, I have insured, so I have transferred my risk to somebody, so I don't need to worry. So with that kind of an attitude, that kind of a behavior will create moral hazards. So keep that in mind. There are two types of hazards. The physical hazards are mainly the physical injuries that you may face, and they are inevitable. You can't stop. You can do certain controls. You can minimize it, but it's beyond your control. You are not purposely doing it. You don't have any intention of getting into these problems. But moral hazards are different. They are because purely your behavior and your honesty, your carefulness matters, and because of that, there will be losses. So that's very important to understand these two, because moral hazards are a very bad, unethical practice in insurance. And so just to give you some glimpse on the insurance market, there are sellers, there are buyers, there are intermediaries, and sellers, of course, the insurance companies. We have around 30 companies in Sri Lanka, and there are so many individuals and organizations who are going to be the buyers of this insurance market, and intermediaries are the brokers. Now there they say that about 40,000 brokers are there in Sri Lanka, and their mainly job is to sell insurance policies and connect the buyer and the seller in this market, right? So also you need to understand they are very they play a very important role in the insurance market because they generate the leads to the market and expand the business from year to year, right? So we will learn more about it, and you are going to explore more about the insurance market, and your assignment is also more focused on the insurance markets and trends. There you will understand in detail what is this market is all about. So going forward on the insurance market, there are kind of key things or scales or the indicators that we used in the insurance market to understand the performance. As you know, when a country is developing, the insurance market automatically grows because insurance is something people are going to invest as as a security option, as a safety option. So when they have when your income goes up, people tend to go from main necessary products also to products like insurance. It will add on or increase the lifestyle of people. So so countries development will connect with insurance development as well. So some of the key ones are: the first, the total premium of all insurance companies. So every year we have to understand how much of total premiums are generating and how the trend goes. So we have clearly seen increasing trend over the years in Sri Lanka, both life and general. And the second point, insurance penetration ratio, it should be ratio. Here what we are trying to understand is the total value of this insurance premium across all the insurance companies as a percentage of the GDP. So higher the penetration will give an understanding the growth of the sector. And the last, uh, the ratio, the percentage of working population insured. So here we are trying to understand how many policies were issued during a year over its working capital population. That will give you an understanding again how the insurance penetration in the country. Right, so having said that about the indicators to measure the insurance market, let's quickly understand some of the further terms on insurance and risk. Now, risk is a word that we highly talk about uh, in the insurance. As I mentioned at the beginning, it's about sharing the risk. So when you say the word risk, another key word comes to our mind is uncertainty. So we need to have an understanding what is risk, what is uncertainty. There is a distinct difference between risk and uncertainty. A lot of people don't know it. They take it simultaneously. What is risk? Risk is all about it is an uncertain event which we can do not know whether it will take place or not. It's an uncertain event which we do not know whether it will take place or not. Uncertainty implies doubt about the future due to lack of knowledge and imperfect knowledge. I'll give you a simple example, the risk and uncertainty. Then you will be clear on this. Risk is, death is a risk because we definitely know that everybody is going to die. So it is uncertain, an event which we do not know whether it will take place or not. So risk is something, now the death is, we know that, but we are not sure. We are not sure when it's going to happen. Right? However, in the risk, the most important part is you can measure that. Risk can be measured. So how can we measure the risk of a death? That is, as I told you, the mortality table. Based on past statistics, you can calculate what is the risk of your dying in the following year. What is the risk you are dying in at the age of 35? What is the risk that you are dying in at the age of 40, 45, 50, 55? Like that, there are mortality tables where they will calculate your risk. So risk can be measured through probabilities. But uncertainty cannot be measured because uncertainty is why where we can't definitely say that this person is going to die by this date or this year. Why? Because it's uncertain. It's very subjective. The probability will, now you have to clear this mind very clearly. Risk and uncertainty. Uncertainty cannot be measured. Risk can be measured. Uncertainty is where you are telling that, confirming that okay, uh, uncertainty refers to that it's difficult for somebody to tell okay, the person is going to die definitely by the year 30, age of 34. That you can't tell. That's we call uncertainty. But we definitely know that person is going to die and we can measure that as the probability of death. That is risk. Okay, let me tell again. Risk and uncertainty. Risk you can identify and measure that uncertainty. But uncertainty is something you cannot measure because you can't tell that. Because of this uncertainty, because risk and uncertainty is connected. So uncertainty you can't measure, but risk you can measure. So what you do is uncertainty, they put it in the they tabulate and calculate the risk of it and identify as a possibility of occurring. Right? So therefore, if you take this example, uncertainty implies doubt about the future due to lack of knowledge. Nobody has that knowledge to tell, okay, this is going to happen like this. It's uncertain. So whether the car will meet an accident at 4 p.m. today, whether your house will be burned by this date, it's uncertain. We can't definitely tell it's happening or not. But if you can measure it, saying, okay, what is the possibility of your vehicle to be met with an accident by that, that is risk that you measure, right? But you can't say whether it's happening or not, but you can say the possibility of happening based on the on a probability basis, right? So this is, you have to be very clear. I hope you are clear on that. So let's try to understand these couple of the features of this risk. And normally when you have the risk, especially when you are insuring, you need to have the frequency to understand this. The frequency is the number of occurrences, number of times that chances that can happen, right? Now, for example, we know 2004 we went through a major catastrophe, tsunami. Tsunami is something that we can't forget, right? So tsunami has a huge impact to the country. And if someone asks what is the frequency of tsunami, is a question, because we never had a tsunami for the last 50 60 years. They say a couple of years, a couple of decades ago we had that issue, but not to this level of thing. So therefore we have a problem of calculating the frequency. So then again we have a risk of insurances. Why? The frequency have an issue. So normally for us to understand, to calculate, there should be a frequency of occurrence. Now, if you take the example again, the other point is the severity. Now, severity, we know definitely it's a very high severity, and you should be able to measure in financial loss. So, at the end of a tsunami, when something happened, let's say in Japan, they will say, okay, there is a loss of this amount because of this tsunami. So, it will measured. So, that is also very important. And the other point is we call this peril, the cause of the loss. So we need to have a very clear understanding what is the main cause for that loss. We will do this in future insurance principles, and we need to see now, for example, if you look at in this picture, there is a house, nearby there is a river, and let's say during a rainy season, um, this this particular house is has been there's a overflow of high water due to the river uh, is been flooding this particular area. Now, if someone asks, okay, what is the reason for that loss? It's due to the continuous heavy rain and the continuous water flow. So therefore, you should be able to understand the main peril. Now, if someone die, there is a reason for the death. So it can be a heart attack, it can be death due to a cancer, or so like that. You need to find that particular cause, and based on that only the compensations will be paid. So we call this peril in insurance risk. Right, okay. Now I will just highlight couple of, we call these options of handling risk. Now you all list down couple of risks that you may face, and you can do different treatments to manage this risk. Some risk, of course, you have to realize you cannot completely eradicate. In other words, completely avoid. Some risk you can control, some risk you can prevent. Like that, you have different alternatives or options to handle the risk. So the first one, avoid. So avoid means try to stay out of a particular risk. Now, for example, you want to go to the university to let's say meet someone, and let's say on the way to the university there is a risk that you will met with an accident. How can you completely avoid this risk? Simply by not going to the university. At that time, let's say there is a chance that you will met with an accident. So to avoid that, you may not go. I'll give you a simple example. Let's say when you want to go to, say you want to go to Singapore, right? Or let's say you want to go to India, or you want to go to Australia. Either you can go in the train, sorry, either you can go in the plane, or you can go in the ship. Now, if you go in the plane, there is a chance, in case if something happened to the plane while you are traveling, if it is, uh, it can destroy, right? So, to avoid that complete risk, in other words, if you want to avoid die by a plane crash, simply you don't need to go in a plane. Simple as that. So there are people who never go on a plane so that they are very scared. There are, very high level profile people who completely avoid going on air. So simply they are scared and they don't want to take a risk of going through a plane crash. So it's simply you avoid it. So you don't, you completely eliminate it. So that's a one way of handling the risk. Sometimes it's not possible. Sometimes you have to go to the, now here you have to go to the university. So maybe you have to look for another alternative. Prevent. Now this is where you are taking some precautions to minimize the risk. Okay, to avoid getting into a, let's say instead of going in a bike, you might go in a, let's say in a cab or something where you can minimize the risk, open risk to a certain extent. That does not mean that you can completely avoid it, but you can prevent it. Maybe when you are working in a construction place, there are a lot of tools you can wear, like helmets, wear gloves, things like that, so that you can prevent yourself by meeting with an accident. Now in a, here we have say use sprinklers and extinguishers. Now when you are in a workplace, especially to minimize the fire threat, they have sprinklers connected on the top of the roof, where the moment when there is a fire alarm goes and certain um, where we have a certain percentage of temperature increasing and smoke goes, automatically there will be water lines coming and minimize the damage of the fire by having sprinklers. Fire extinguishers also the same, where you have seen red color, like a long like a bottle where they fix in places in office, where if something if there's a fire comes, you can quickly use these fire extinguishers and stop and prevent the spread of the fire. The next one I would say limiting this. Now this is also, you can't completely avoid it, but you can reduce it by having certain precautions. For example, now if you take an example, we always face the risk, especially when you build houses, when you have earthquakes and all, there's a chance that our houses can, or buildings can, crash. So so what they can do is, you can have a building with a solid construction, so that even when there is even there's a strong earthquake, it will not breakable. Now countries like Japan, because they have heavily earthquakes all around, if you see their houses, they are very simpler, and they are not like made with big iron bars and concrete and all. It's made with light wood and very simple, so even something goes wrong, the loss is limited. So you can either you look for that kind of an arrangement, or a very solid construction that to minimize the complete harm. It's depending on the requirement. And the other one is accepting the risk. Now a lot of us are used to accepting risk as well. Okay, we accept now. Yes, we when for example there are some people they have the third party insurance but they won't get the full insurance because of the minimum requirement. They put the third party but not the full insurance, and they sometimes when you ask they said okay fine, every year we have to pay insurance policy, so we have actually have a separate fund for that. So even if you met with an accident, we are trying to set off from that self fund. Or for example, let's say you have a lot of vehicles in your group of company. Every year, rather than paying a huge insurance premium, you collect certain funds, self fund, and if something goes wrong one of your vehicle, they will use that money to set off. On other hand, let's say there's a risk that you can get ill, and you instead of opening or taking a medical or health insurance policy, you every month you allocate certain money because in some of one of you or your family member get ill, you can use that money to settle that medical expenses. So accepting the risk is another way of handling your day-to-day risk. And finally, transferring. You are giving your risk to somebody outsider by obtaining an insurance. Like I said, you are transferring, you are sharing your risk to a insurance company so that if something goes wrong, there's someone to take care of your risk, right? So for example, life insurance, of course, again another example, when something happened to you, that risk of your financial loss, not everything that you can recover, your risk of the financial loss can be recovered by the life insurance policy. For example, when you die, you won't get the money. You are now a dead person, but your spouse and children might get the money and avoid that financial hassle that they will go through by losing you, right? So these are the possible uh, risks that you can face and how you can handle them, right? Okay, so so let me quickly go through what we discussed for the betterment for everyone in both single medium as well. Now as you can remember, we initially understand what you really mean by insurance, and we understand that insurance is very important for us. And when it comes to the concept of insurance, I told you that insurance is trying to share the risk or between people who are interested with a similar risk exposure, and as a result you will be able to minimize your risk. And then I explain you the concept of the insurance policy uh, and how it's coming. මම example එක ගත්තේ farm එක අර එළදෙන්නෝ ආරක්ෂා කරගෙන ඉන්නවා farmersලා ටිකක්. ඒගොල්ලන්ට ඒ ගොවියන්ට මොන හරි ප්‍රශ්නයක් වුණොත් ඒගොල්ලන් එකතු වෙලා හැම අවුරුද්දෙම එකතු අයින් කරන කොටසින් එකතු වෙලා තියෙන ෆන්ඩ් එකෙන් ඒගොල්ලන්ට ඒකට ඒ අදාළ පාඩුවට මේ මුදල් ලබාගෙන ඒ පාඩුව අවම කරගැනීමේ හැකියාව තියෙනවා මේ 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 කන්සෙප්ට් එක. මේ කන්සෙප්ට් එක තමයි අපි ඉන්ෂුරන්ස් රක්ෂණය කියලා අපි හඳුන්වන්නේ. ඊට පස්සේ රක්ෂණය අපි අතීතයට ගියා 1752 බෙන්ජමින් ෆ්‍රැන්ක්ලින් කියන ඉන්ෂුරන්ස් කම්පැනි එක ලෝකේ පරණම ඉන්ෂුරන්ස් කම්පැනිස් වලින් එකක් විදිහට සලකනවා. මේ ඉන්ෂුරන්ස් කන්සෙප්ට්ස් මුලින්ම හඳුන්වා දුන්නා ආයතන විදිහට. නමුත් 1688 කාලෙදි තමයි ලොයිඩ්ස් ඔෆ් ලන්ඩන් වලදී ගොඩාක් ඉන්ෂුරන්ස් කන්සෙප්ට්ස් මේ ලෝකෙට මේ ආවේ. නමුත් ඉන්ෂුරන්ස් කිව්වහම ඒක ගොඩාක් පරණ ගොඩාක් අතීතයට යන කන්සෙප්ට් එකක්. අපි කිව්වා වගේ රෝමන් අධිරාජ්‍ය ග්‍රීක අධිරාජ්‍ය කාලේ පවා ඉන්ෂුරන්ස් කියන concept එක තිබුණා කියලා සටහන් වෙනවා. ඊට පස්සේ අපි කතා කළා ඉන්ෂුරන්ස් රිස්ක් ගැන. ඉන්ෂුරන්ස් mainly risk දෙකක් තියෙනවා. pure risk and speculative risk කියලා. pure risk කියලා අපි අදහස් කළේ ඉන්ෂුර් කරන්න පුළුවන්. දැන් අපිට තියෙන අවදානම් වලින් රක්ෂණය කරන්න පුළුවන්. රක්ෂණ අවදානම් වලින් රක්ෂණය ගත කරන්න පුළුවන් අවදානම් තමයි මේ ඉන්ෂුරබල් රිස්ක් විදිහට pure risk විදිහට අපි අයිඩෙන්ටිෆයි කළේ. ස්පෙකියුලේටිව් රිස්ක් කියලා කියන්නේ එහෙම රක්ෂණය කරන්න බැරි දේවල්. මොකද ඒකෙන් ලාභයක් හෝ පාඩුවක් නැත්නම් අවුට්කම්ස් දෙකක් වෙන්න පුළුවන්. නා පළවෙනි එකේදී හැම වෙලාවෙම ඒකෙන් ලොස් එකක් නැත්නම් පාඩුවක් විතරයි වෙන්නේ. එකම අවුට්කම් එකයි තියෙන්නේ. නමුත් ස්පෙකියුලේටිව් රිස්ක් එකේදී ඒකේ වාසියක් හෝ පාඩුවක් වෙන නිසා ඒක අපිට රිස්ක් එකක් විදිහට ඉන්ෂුර් කරන්න බෑ කියලා කියනවා. ඊට පස්සේ ඉන්ෂුරන්ස් රිස්ක් එකේදී අපිට අදාළ වෙච්ච ප්‍රධානම කරුණු ටිකක් අපි අදහස් කළේ ඒවා මුදල්මය වශයෙන් මනින්න පුළුවන් වෙන්න ඕනේ. ඒ වගේම මේ කියන්නේ ඉන්ෂුරබල් ඉන්ට්‍රස්ට් එකක්. ඒ කියන්නේ ඒකට අදාළ ඉන්ෂුරන්ස් පාර්ටිස්ුත් එක ගත්තාම ඒකට අදාළ වන ඒකට සබ්ජෙක්ට් මැටර් එකක් තියෙන්න ඕනේ. ඒකට අදාළ වෙන මේ කරුණක් තියෙන්න ඕනේ ඉන්ෂුරන්ස් සම්බන්ධයෙන්. ඊට පස්සේ විශාල ප්‍රමාණයක් ඒකට අදාළ ඒ ඉන්ෂුරන්ස් එක සම්බන්ධයෙන් සමාන අවදානම් තියෙන විශාල සමූහයකගේ එකතුවක් වෙන්න ඕනේ. ඊට පස්සේ ඒ වෙන අවදානම ඒකෙන් වැටෙන පාඩුව අපිට හරියටම මේ ගිණුම් ගත කරන්න පුළුවන් වෙන්න ඕනේ. ඒ වගේම අපිට ඒක හරියටම කියන්න බැරි වෙන්න ඕනේ. ඒ නිසා තමයි අපිට unforeseen nature කියලා කියන්නේ අපිට ඉස්සරහට ඒක වෙනවද නැද්ද කියලා කියන්න බැරි එකක් වෙන්න ඕනේ. ඒ වගේම අපේ තියෙන මුදල් පසුබිමට වඩා ඉහළින් මේකට යන්න බෑ. ඒක අපේ financial capacity එක අපේ තියෙන මුදල් මේ හැකියාව මූල්‍යමය හැකියාවත් එක තමයි ඒක රඳා පවතින්නේ. ඊට පස්සේ අපි කතා කළා physical hazards and moral hazards කියලා. physical hazards කියලා කියන්නේ අපි කිව්වේ සාමාන්‍ය එදිනදා ජීවිතයේදී අපිට ඇතිවෙන කායික අපිට වෙන අවදානම්. නමුත් moral hazards කියලා කියන්නේ ගොඩාක් අපේම ක්‍රියාවලිය නිසා අපේම වැරදි ගති පැවතුම් නිසා ඇතිවන මේ අවදානම්. ඒවා ඇත්තටම මේ කැල්කුලේට් කරන්න හරි අමාරුයි. කියන්නේ ගණනය කරන්නත් අමාරුයි. ඒ වගේම ඒක මේ මිනිස්සෙගේ ක්‍රියාවක් නිසා වෙන නිසා ඒක මේ ඉන්ෂුරන්ස් වලදී අපි ඇක්සෙප්ට් කරන්නේ නැති දෙයක් විදිහට තමයි අපි moral hazards කියන එක දකින්නේ. ඊට පස්සේ අපි ඉන්ෂුරන්ස් මේ වෙළඳපොළ ගත්තාම රක්ෂණ වෙළඳපොලේ ප්‍රධාන වශයෙන්ම අපි දකිනවා රක්ෂණ ආයතන තියෙනවා. ඊට පස්සේ රක්ෂණ පාරික ගෙවන ඒ වගේම රක්ෂණ මේ ඔප්පු ලබා ගන්න රක්ෂණ හිමියෝ ඉන්නවා. ඒ දෙගොල්ල සම්බන්ධ කරන බ්‍රෝකර්ස්ලා ඉන්නවා. ඒගොල්ලන්ගේ මේන් රක්ෂණ නියෝජිතයන්ගේ මේන් අරමුණ තමයි ඔය දෙගොල්ලන් සම්බන්ධ කරලා ඉන්ෂුරන්ස් පොලිසිස් ඒගොල්ලන්ට දෙන එක. ඊට පස්සේ ඉන්ෂුරන්ස් මාකට් එකේ නැත්නම් මේ වෙළඳපොලේ අපිට බලන්න පුළුවන් තියෙනවා නිර්ණායක පළවෙනියටම රටක් විදියට හැම අවුරුද්දෙම මේ ඔක්කොම ඉන්ෂුරන්ස් රක්ෂණ ආයතන වලින් ගෙවන මුළු වාරික ප්‍රමාණය එකතුව විදියට ඒගොල්ලන් කැල්කියුලේට් කරලා බලනවා කොච්චරක් රටේ අවුරුද්දෙන් අවුරුද්ද ඒකේ ඉදිරියක් තියනවාද කියන එක. ඊට පස්සේ මේ සම්පූර්ණ වැලියු එකම අපේ රටේ ජලදාතික නිෂ්පාදිතයේ ප්‍රතිශතයක් විදියට අපි හඳුන්වනවා. ඒ වගේම අලුතෙන් පොලිසිස් කියන්නේ අලුත් රක්ෂණ මේ ගිවිසුම් කොච්චරක් නිකුත් කරනවද කියලා අපේ රටේ ශ්‍රම බලකායේ කොටසක් මේ percentage එකක් විදියට ප්‍රතිශතයක් විදියට අපිට හඳුනා ගන්න පුළුවන්. ඒවා නිර්ණායක විදියට අපි හඳුනා ගන්නවා රක්ෂණ වෙළඳාමේ තියෙන ප්‍රගතිය සමාලෝචනය කරනකොට. ඊට පස්සේ අපි risk and uncertainty ගැන අපි කිව්වා. risk කියලා කියන්නේ හැම වෙලාවෙම මම අර ඉස්සෙල්ලා පැහැදිලි කළා වගේ ඒක හරි ඒක ඔබ්ජෙක්ටිව් ඒක අපිට ගණනය කරන්න පුළුවන් දෙයක්. ඒ කියන්නේ අපිට කියන්න පුළුවන් ඕනම දෙයක් වෙන වීමේ හැකියාව කැල්කියුලේට් කරලා තියන්න පුළුවන් දෙයක් තමයි. නමුත් අන්සර්ට්නි කියලා කියන්නේ අපිට ඒක කියන්න බෑ හරියටම. ඒකෙදී වෙන්නත් පුළුවන් නොවෙන්නත් පුළුවන්. නමුත් රිස්ක් එකේදී අපිට හරියටම කියන්න පුළුවන් වීමේ හැකියාව මෙච්චරයි නොවීමේ හැකියාව මෙච්චරයි කියන එක. ඒක තමයි මේන්ලි අපිට රිස්ක් ඇන් අන්සර්ට්නි කියන එකේ වෙනස විදිහට හඳුනා ගන්න පුළුවන්. ඒකෙදි ගොඩාක් බලපාන එක තමයි කොච්චරක් වාර ගානක් ඒ කියන්නේ ඇතිවීමේ සම්භාවිතාව අපි කැල්කියුලේට් කරන්න ඕනේ. ඊට පස්සේ ඒකේ තියෙන මේ අවදානමේ වටිනාකම ඒකේ තියෙන අපි කියනවා සිවියරිටි කියලා කොච්චර මට්ටමකට ඒක බලපානවාද කියන එක අපි මුදල්මය වශයෙන් මැනීමක් සිදු කරනවා. ඊට පස්සේ ඒකට ප්‍රධාන හේතුව මූලික හේතුව හඳුනා ගැනීමක් කරනවා. මේ වගේ දේවල් අපි වඩා මේ ලක්ෂණ මූලධර්ම වලදී අපි ගොඩක් මේක ගැන අධ්‍යයනයක් කරනවා. නමුත් මේවා ප්‍රධාන කොටස් විදියට අපිට දකින්න පුළුවන් ඉන්ෂුරන්ස් පොලිසි එකක් හදනකොට. ඊට පස්සේ අපි කිව්වා දැන් මේ විවිධ තියෙන අවදානම් වලට විසඳුම් වශයෙන් අපිට විවිධ උපක්‍රම තියෙනවා සම්පූර්ණයෙන් ඒක නැති කිරීමත් ඒක අවම කිරීමත් ඒ වගේම අඩු කරන්න සම්පූර්ණයෙන් ඒක ඇති වෙන එක වළක්වන්න ඒ වගේම ඒක පිළි අරගෙන ඒක මැනේජ් කරගන්නත් ඒ වගේම සම්පූර්ණයෙන් ඒක එන ඉන්ෂුරන්ස් කම්පැනි එකට ට්‍රාන්ස්ෆර් කරලා එහෙම නැත්නම් බාර දීමේ කියාවත් තියෙනවා මේ විවිධ අවදානම් වලට විවිධ විදිහට අපිට සැලකීම් කරන්න පුළුවන්. Right. Now I think you have a better idea about basic insurance. So we'll go into detail in the next couple of sessions. So please go through that, and if you have any questions, I'm more than happy to discuss in the next session. Thank you very much. Have a good day to you.